What will be the gold price in dollars 1 year from now? I heard it could be 5,000 in 2 or 3 years. What does Jordan say?
I am going to say 2,700.
Wow. Okay. All right.
Well, I mean, here's the thing. When gold breaks above 2,100, let's say if and when, because of course we can't predict the future, but, presuming it does break above 2,100, I think that'll, I don't want to say definitely because you never know, but I think it will happen sometime this year.
Welcome to In It to Win It. This is Steve Barton, and thank you for tuning in. We are back with our resident gold and silver expert, Jordan Roy-Byrne from the Daily Gold. Jordan, thanks for coming back on the show.
Steve, thanks so much for having me. It's a pleasure to be on with you, as always.
Yes, sir. Yes, sir. The pleasure's all on this side of the table, sir.
That's a great movie. That's a great movie, by the way.
It is, isn't it? All right, we got some listener questions. We're going to look at charts, but first, let's start out like we always do. What is your macro big picture view of the precious metals and financial markets?
Well, my big picture macro view for precious metals is I think we're probably over the next, 2, 3, 4 months or so, we could be going into the very end of a secular bear market. And so in other words, gold's rallied up to resistance. It's pulling back now. If you look at the action in silver and the miners, that's telling you gold is probably going to sell off more than what it has over the last couple of days. And I think that the correction that has just started, and again, I don't know if it's going to last month, 2 months, 6 months, 3 months, whatever. I'd probably guess 2, 3, 4 months, just off the top of my head, something like that. That is probably going to lead to the explosive breakout move in gold, which is going to be the start of not only a new cyclical bull for a couple years, but a new secular bull, a new decade-long bull market for not just gold, but for precious metals, and then I think for resources as a whole. So we're getting into something really exciting. And at the same time, if we're thinking about the macro, the economy has held up, I mean, you could say reasonably well so far to this point. But if you look at the inverted yield curves, and if you look at the median time from the inversion to when the recession actually hits, a lot of the median times for all those curves, I mean, they're pointing to July, October, September. So based on the data, it's always been, and based the yield curve data, the recession should hit in the third quarter. So we're not even in the third quarter yet. Granted, we're getting much closer to it. So I say all that to say, I think we're going to have a recession in the second half or later this year. And when that happens, inflation expectations, I think, are going to plunge. It doesn't mean prices are going down. It's just that prices will not rise. They might flatten out, but they're still way higher than they were a couple of years ago. And that's a big problem because, as this recession hits, there's going to be more pain for the banks. The consumer's been holding up, but, they're going to be in trouble. So that's basically going to lead to rate cuts. The Fed has a lot of room in which to cut rates now because they're at 5% or whatever it is, 5.25. And I think you'll get fiscal stimulus on top of that. It's just that the policymakers, they need more pain before they can do that. They need the switch to flip from inflation being the concern to growth and recession. I think we're really close. I think that point will shift in the next 2 or 3 months where people have forgotten about inflation and recession will be the big talk. So I know it's a long answer, but my big picture macro outlook is recession is coming, and that's going to lead to a new cyclical, but also secular bull market in precious metals. So the downturn that's coming is going to be the catalyst that gets precious metals to make this huge move that everyone's been waiting for. And, beyond that, once the economy bottoms out, recession's close to getting over, you'll see, other commodities, resources will start to perform. The stock market will have a new cyclical bull in the next couple of years, but it won't be anything that great. So I think the big picture macro outlook is incredibly bullish for precious metals, but the next 2, 3, 4 months might be a little difficult and could be a big head fake.
Okay, maybe that's another accumulation period. I've been looking at the CMA tool, and it has the overwhelming consensus is that they're going to start cutting in the September 20 meeting. So that would kind of feed into your thesis.
Yeah, I mean they follow the market, so it's just a when and when you look at the big declines during bear markets and stocks, like when the market really has like an accelerated move lower, it tends to be when the recession hits. Now we don't know that because the NBER, who makes these calls, National Bureau of Economic Research, they'll do it after the fact. So if you see, and typically like August, September, October, I mean more so August and September, in bear markets or recessions, like those tend to be really bad months. So if you see the market start to, I want to say plunge, but if you see a decline start to, it's breaking levels, you see a sell-off in the stock market that's picking up momentum at the end of the summer, people are getting worried into if that happens in August, then the market will they'll immediately discount where the Fed is going to cut. So my guess would be September, but I mean that long, my long answer aside, it all depends on the market. If nothing happens to the economy and and things are the same as they are now, 3-4 months from now, then the Fed won't cut. So it's all market dependent. But and again, it's just a guess, but yeah, I would think September. That's a good guess for when the first cut would be, unless things like really start to unravel in the next month or two, then you'll get a cut much sooner. But make no mistake, rate cuts are coming. This idea that they're going to pause and hold rates at 5% for, a year is just ridiculous. I mean, the economy is going to go into recession and rate cuts are coming, whether they happen sooner than September or later. They're cutting, and they're going to be cutting significantly into next year.
Okay. All right. Okay, on to our first listener question. This is from Lucky Piston. Do you have your crystal ball handy?
There
it is. He wants to know.
I have an imaginary one right here.
Okay.
Yeah, you can't see it.
What will be the gold price in dollars 1 year from now? I heard it could be 5,000 in 2 or 3 years. What does Jordan say?
I am going to say 2,700.
Wow. Okay. All right.
Well, I mean, here's the thing. When gold breaks above 2,100, let's say if and when, because of course we can't predict the future, but, presuming it does break above 2,100, I think that'll, I don't want to say definitely because you never know, but I think it will happen sometime this year. So you get the break above 2,100, you're going to see an accelerated move, really significant gains. I mean, if you look at the gold chart historically, you can see points where it really moved quickly. And then a lot of the time, it really doesn't move that much. So I think, again, if you tell me it's going to break 2,100 this year, then I would think 2,700 is a reasonable guess. I mean, I guess looking outside, it's such a nice day. So I'm thinking, are we talking in July or August? But it's really, we're still in May. So 2,700 might be a tad aggressive, but I'll leave it there. I think it's, assuming gold breaks above 2,100 before the end of the year. I mean, we get October, November, you see that break. That's a reasonable guess. Now a lot of gold breakouts have occurred in September. So if we get the breakout in September, I would say, 2,700 is a good guess.
Okay. Yeah. What's interesting as far as technical analysis is concerned is once you break to an all-time high, there is no resistance. It's never been done before. It's kind of neat.
And Steve, that is extremely significant. I mean, and people, I think, underestimate the significance of that. And especially when you're coming off of, now granted, we're a little bit above where we were 12 years ago, but we haven't broken away from that. We haven't, gold has, we got the handle on the cup. So gold hasn't really broken away from that 2011 high because, I mean, it's gone a little bit above it, but it's gotten stopped now 2 or 3 times. So eventually breaking above 2,100, that's a multi-decade breakout. A 12, 13-year breakout, that's extremely significant. I mean, historically in markets, I mean, and I've said that's going to be the most significant breakout for gold in 50 years. And that's not cheerleading. That's just looking at the history of gold, what I know about technical analysis. And so I'm really excited and, confident in that call.
I'm excited too. Yeah, you wouldn't be able to slap the smile off my face. Okay. CA from YouTube asks, what is Jordan's take on cycle analysis? Is there any value to it? Thank you.
Yeah, I think long-term cycle analysis, if you're looking at, there tends to be cycles between, you have bond bull markets tend to be really long. And, more specifically, there's an interplay between stocks and commodities where stocks are in a secular bull market, commodities are in a secular bear, and then, it reverses back and forth if you look at history. And so, and we're in a, the period now is very similar to the mid to late 1960s where, I don't want to say it was difficult to tell, but I mean, there was a lot of overlap there in a short-term sense. And you will see overlap in the short term. Like you go back to the early 2000s, commodities were in a new secular bull, stocks were in a secular bear, but, stocks did, they had what was it, 2002, 2003 to 2007. So in 2 or 3 year periods, they can trend together. But if you're looking at the big cycles historically, stocks go into a secular bear. That means commodities go into a secular bull. So I like and appreciate cycles like that. There is another one where inflation every 30, you've had a peak in inflation every 30 years, a major peak every 60 years, going back to the Civil War, 1920, 1980, but 2040 or so. So that, I mean, this inflation that's barely starting, it's still, I mean, the inflationary period, there's still a long way, more than 10 years that it has to run. So those are the cycles that I kind of like. But this idea that, oh, there's a cycle every, gold has like a 7-year cycle, there's a 3-year or a 4-year cycle, the dollar has a 15-year cycle. A lot of that stuff is, it's not predictive, it's not objective. And Elliott waves are similar. I mean, Elliott waves are better than cycle because there's some market-based objective tenets in Elliott waves, but still, these things are not predictive. And the problem with cycles is the cycle practitioners are so married to the cycle that they try and map what's going on in the market to the cycle, which is asinine. I mean, it's completely backwards. The market is what you need to focus on. And yes, I mean, there's some cycles in some markets, but they're not predictive. And to give you an example, gold, people talk about how there's a 7-year or 8-year. So first of all, it was an 8-year cycle. And then the last low was 7.5 years. And so it became a 7.5-year cycle, and the low last year was 6.9 years. And so people are saying, oh, that was the 8-year cycle low. But, let's say gold goes to 1800 before it blasts off. I'm not predicting it. I'm just throwing out a number. Well, in 5 or 10 years from now, the cycle guys will say, "Oh, well, that was the 1800. That was an 8-year cycle low. It wasn't the 1630 the year before." So, I mean, does this sound like something that can really help you make money?
Right. Yeah.
I mean, I don't mean to babble on about it, but it's not objective. And I'm not saying every cycles guy, but a lot of guys who do this stuff and only look at cycles, I'm sorry, but they're quacks. I mean, most of the stuff is not technical analysis. It's quackery. And you have to be really careful. Like it's the idea that you can look back in history and something happened every 7 or 8 or 15 years, it has to happen again. I mean, it's not predictive. Like, so I don't mean to drone on about it, but that's why I'm not a fan of it, because it's not objective, it's not technical analysis. And the idea that this cycle is the holy grail and crystal ball and it'll tell you where things will bottom, it's not going to work out because we can't predict the future. So you have to be very, very careful with that stuff. It's not objective. It's not predictive. And I will say this, the best cycles guys, they're using technical analysis on top of the cycles. Like that should just tell you something about, like, I give them credit for using real technical analysis in addition to the cycles, but the fact that you can't use cycles on their own, that should tell you something.
Okay. All right. Fib 618, he asks, How do I tell the difference between regular folks and paid promoters of junior mining stocks who also regularly pump and dump on Twitter?
Wow, I could I could take that in a number of directions. Well, I think everyone, I mean, everyone has a bias, and so I just think you have to try and use common sense if you're looking at certain tweets. I mean, you can observe maybe someone who's making an intelligent point about the geology or the metallurgy or about a study versus someone who's just outright cheerleading. And, most of the things you'll see on mining Twitter are of the cheerleading variety. So when you see cheerleading variety, there's not a lot of detail behind it. You see people with accounts that don't use their real name. I mean, that's a huge flag. And I'll just say, and I'll say this again, everyone has some kind of a bias, and you need to tread very carefully and you almost need to assume everything you hear is bull and then work from there and work backwards. Like, everything's bull. I need to go, do more research and substantiate if what this guy is saying about this stock is true. Now, obviously there's much better sources and people you can look to. I think I'm one of those in that category, but at the same time, you never should rely on one person. You should subscribe to several people who are really good and honest, and you can ask them questions, and over time you'll be able to learn a lot more. I mean, I've been in this industry for 20 years. Like, I didn't know jack 20 years ago, to be honest. I mean, it took me a long time to get to this point. So yeah, I just use common sense, tread carefully, assume it's bullshit, and then work back from there. And people who aren't using their real name, that's a huge sign.
Okay. All right. Peaceful Volume asks about the Canadian Venture Exchange. CDNX down over 80% from the 2007 high, down more than 70% from the 2011 high, and over 40% from the February 2021 high. Is the CDNX and or the Toronto Stock Exchange divided by the CDNX charts providing any clues?
I mean, I think they can provide clues. I know some people who use those, but I think the one issue with the CDNX is it's not entirely resources. You have marijuana companies in there. You have, biotech, tech stocks. So, I mean, it would be nicer if there was an index that was, just 100% junior resources. But, nevertheless, I mean, it is an okay proxy for junior resources. And I think, look, we've been in, and at some point very, very soon, we're coming out of a secular bear market. And so if you look at where metals prices in the last decade, they haven't made new highs. They've been, correcting, going sideways. Everyone is different, but every commodity is different. But that's been the issue, is you haven't seen higher highs and new highs in the metals since 2011. And at the same time, think about how much costs have gone up. The cost to run these companies, if you're raising 5 or 10 million, it went way further in exploration work 10 years ago than it does now, even compared to 2 or 3 years ago, because we know there's been a lot of cost inflation in the industry. So those things speak to what's happened over the last decade and why these commodity, or why these stocks are so far off their highs in the index as a whole. But I do think that, again, as we get into new secular bull market, you're going to see gold is going to be the first one to break out. Depending on, silver might be the next one, although it has a ways to go. But if you look at the charts of copper and oil, and you're looking at them, just over like 100-year, 50-year time period, you can see that eventually in the coming years, like, they're probably going to break out and make new all-time highs. So if and when we see these things happening, that's a sign of a new secular bull market. And so I think that, the CDNX, I mean, using that, dividing it by the TSX, it can be a reasonable indicator. And so, when you see the CDNX really start to, catch on fire and really outperform, that could be a signal, a confirming signal that, yes, we're in a new secular bull for the entire resource space.
Okay. All right, I'm going to share my screen here. We're going to take a quick look at some charts. This is the S&P 500. I've got some trend lines drawn here, at least where I think the next resistance levels are for it to the upside. I got it basically 42, 43, and 4,400. Where do you see this going in the next month or so?
Yeah, it's really a tough call. I mean, I think there is a risk that you could see a move higher in the S&P that turns out to be a false move. So I mean, even though we're talking about the bearish macro backdrop, the timing is incredibly difficult, and so I looking at that, I think it's possible you could see more buying come in, push that up to, like you were saying, 43, maybe even 4,400. Before before the recession hits. I mean, that's a possibility.
Yeah.
So I mean, yeah, it's a really tough call because market breadth is really terrible, and there's only a few stocks that are holding up the market and causing it to rise, or at least hold up in the last couple of months, as you can see.
Yeah, there's like 10 of the 500 in here that are just carrying all the weight.
And so when the economy goes into a recession and capital can no longer hide in those 10 stocks, like that's when you're going to see that accelerated decline that I was talking about. You get that big sell-off in the stock market, which is a sign that, okay, the recession's happening now. But obviously, if we're just looking at the pure price action, it looks reasonably bullish. You have a bullish consolidation over the last month or so. It's holding above the moving averages. I mean,
it's still above the 50 here, and then you got the 100 and the 200 right below it.
Yeah, it looks pretty nice. And so if the data just holds up okay for the next month or so, and then the Fed says they're officially on pause, you could get some more buying, because if you look at sentiment statistics for the stock market, sentiment has been, I don't want to say very bearish, but everybody knows a recession is coming. People are not bullish on stocks. The positioning is not that bullish. So that's the risk. Like if you're a bear and you're playing it bearishly, the risk is that you get a pop in the market, and then that sucks people in. They're like, well, it's breaking out. It's going up. It's going to go back to the high. I got to buy. Then it goes up a little more after that. But then a couple months later, the recession hits, and then it can come back down. So I think that's one potential scenario I'm thinking about.
All right, moving on. Here we got gold. This is one resistance level that we've been looking at for a while, is 1980, which it basically is touching on right now. The next one under that, as I see it, is probably 1950. Is that accurate, or?
Yeah, 1950. I think you mean support.
I'm sorry, support. Yeah.
Yeah. So you have support at 1980, 1950, and then 1900. And I'm also looking at moving averages. I looked at when gold is early in a new bull market, where does it tend to correct to, like typically? And it either corrects to the 50, 100, or 150 day moving average. And so the 50 day, when it's running really hot. So now I don't think it's running hot anymore. You've seen big declines in the short term in silver and the miners. So I think it's not going to bottom at the 50 day. So I'm looking at the 100 day or the 150 day. And also, if we're going to see a more severe sell-off, I would look at, I don't know if you could pull it up, but if you're looking at the monthly, if you look at the 20 month and the 40 month, I think those are in the low to mid 1800s. So the levels that I'm thinking about are 1900, and then in the mid 1800s. And I think 1900, you have the 150 day, I want to say is like an 1860, and that is probably going to hit 1900 in June. So that's one level I'm thinking about. And then, if we're to see even more selling, I would look at, a potential test of the 20 month and 40 month, which you can see. I mean, those are, I don't know what, 1830, 1840, something like that. If you're thinking,
it looks like right about there. This is the, this is the 21, not the 20, but close enough for government work. And then this one right here is the 40.
That's probably That's better than government work if you're that close. But yeah, and so if you're thinking, 2-3 months from now, those moving averages will probably be, I'm just guessing, but maybe around 1850. So long story short, I'm thinking about 1900 and 1850 or so. Those are the support levels for gold. I think we've seen some technical damage in the last week or two. That tells me the probability is we'll probably correct. It'll kind of be like a medium correction. I don't think it's going to be that severe, but it's not just going to be a little blip. So I do see potential risk to the mid 1800s, but 1900 is a level I'm thinking about.
If we put the Fibonacci here at that recent low of 16 something up towards the high, that would coincide perfectly with the 20 and the 40, and that would be right around 1830, 1850.
And that's when you're doing technical analysis and looking at charts. Those are the things you have to look for. Fibonacci, moving averages. What does it do historically? So those are all the things I look at. And that's how I come up with targets. And then also just evaluating the price action. Like you can see, whether you're looking at a, daily, weekly, or monthly, you kind of look and you can use that horizontal line to just kind of pick out, okay, what has been a significant level where, the market stopped at a couple times, or, maybe it came back and found support there. So there's numerous things that I look at, but there's a science behind all of them to try and, build the evidence to tell you, where are the most probable levels as far as, support, resistance.
Yeah. Okay. Moving on to silver. I've got this trend line in. I'm not sure how much stock you put into it, but I call this the silver squeeze down trend line. Right. And we broke through that, I don't know, maybe a month or so ago. And then we just dropped below it again. Do you put a lot of stock into this, or is this basically just silver just following gold?
Yeah, I think it's silver following gold. I'm not a huge fan of trend lines, and silver, it's kind of, I don't want to get into too much of the science behind it, but for silver, if I'm looking at the historical price action, maybe you could zoom out and then can you put a horizontal line in right around 27, 28, whatever it is.
Okay, 27 or $28.
Yeah. So
there's 27. That's probably 28.
Not to, give you more things to do, but if you're looking at if you go back, 20 years, and you can see that 27, 28, that's where silver, when gold and silver had that crash in 2013, they came back down to that area. And so they rebounded. And so, that line that you've drawn that's the most significant line of resistance. Okay. And so silver is not going to really take off. Well, first of all, gold has to break out first. And then after that, silver will probably get going. And so breakouts in silver always follow breakouts in gold. So, big picture, when you see gold break 2100, silver will be on its way to breaking above 28 to 30. Then it will really run. We're talking about vertical, accelerated moves. The same thing will happen to silver, but gold has to break 2100 first. Now, in the short term here, you have a little bit of a double top in silver in the very short term. You can see you have that, and then you have the big sell-off. So the short-term action, 22 is the first support level I'm looking at, then 20. But silver, as you know, silver can get really volatile, and it can, go above these levels, and, it can fake you out on both ends. So, those are 22 and 20 are the levels I'm looking at. But silver is going to follow gold, and in the short to medium term, it's going to underperform gold until the gold correction ends. Gold starts moving up. Then when gold gains momentum, that's when silver will outperform. So I think there's downside risk in the next month or two here.
Okay, man, I hope we get back down to 20. That would be a back up the truck physical bet moment. Okay,
and
especially because sentiment will be in the tank when that happens.
Yeah, and I think this, more than any other time, this will be, because we're so close to that gold breakout finally.
Yeah.
So people always say that, but I think this is actually the next low. This is really the last stand of all the bears and people who dislike precious metals. Like this next couple months, this is their last stand. They better
Yeah.
enjoy it, because after that, it's over. It's over. It's going to be huge.
Okay, this is GDX. I just drew the trend line right where we're sitting today, Wednesday. But where do you see this? Is the major support? I guess if gold continues to go down, none of these trend lines mean anything, right?
Right. Yeah.
Okay.
Yeah. If you zoom out a little bit, I think if you draw, you take that line down to 28, maybe.
Okay.
Yeah, maybe just like, or maybe 27. Like you can see how since last summer, that's been a level that's been tested several times.
Maybe even slightly up right there where we have this triple bottom somewhere around there. All this resistance. What I love about this graph, if I go to the weekly side here, and even more so in GDXJ, is we're at half the price that we were back in 2011. And then if we do GDXJ, I mean, this thing got up to $175, and now we're sitting at 38.
Well, and you can see it's gone nowhere for 10 years or
Yeah.
9, 10, 11 years. Going back to 2013 or so. So that's a really nice long-term base. I mean, it's been frustrating to be in the market, but I mean, it's when you see gold break above 2100, real buying is going to come in to the sector, and this sector is really going to fly finally when gold takes out 2100.
Yeah,
and
yeah.
I will a couple of weeks ago it looked like we were getting really close to that, but now I think it's at least a couple months away, maybe 4 or 5 months. I don't know, pick a number. But again, the setup is there for a real bull market and a huge move higher in the sector, and it all starts with gold breaking above 2100.
Yeah. Okay. SILJ, the junior silver miner ETF. Let me pull up the daily here. And what do you see in store for this?
Probably. Well, it is a nice bullish hammer today, but probably
I was actually thinking of doing a trading position right here today before the market closed. So we got a reversal bar right here on the 200-day moving average. I'm kind of hoping it gets back down to 950 like it did before when we placed our previous bet. But
I think it will.
Okay.
And especially if the macro plays out where you're going into a recession and you see gold continue to outperform silver, the dollar rising for a little while, like those things are not good for junior silver stocks. But what is good, again, is gold breaking above 2100. So,
yeah,
it all comes back to that, because again, that's what you're going to see, the accelerated move. Silver will really move. People will get excited. And I mean, I'm telling you, I mean, it's been a really long time, but when there's a real bull market in this sector, I mean, people buy anything and everything.
Okay.
So these things will really fly. I mean, we're not there yet. I know it's frustrating because I probably said the same thing a year ago or 18 months ago, but we're getting really close to that point. Probably not the next month or two, but I mean, we're getting much closer. And so this weakness that I foresee coming, this is really smart money that's going to be buying it, not just gold and silver bugs.
Okay. All right. Awesome. Well, thank you. We got one last question. This one's interesting. I didn't know this about you. Protract asked, tell us about your career as a DJ. You used to be a DJ before you were a gold and silver analyst?
I should have told you, but no, I was not. I was never a DJ, unfortunately. I know I did that tweet as if I was a DJ, but I did not have a DJ career. I did do some announcing gigs, but no, I never.
Oh, I was picturing you with like a mask on with the records,
No.
No. Okay.
No.
Right on. Well, thank you, Jordan. We can check out all things Jordan at thedailygold.com. There'll be a link down in the show notes. And Jordan's got a newsletter. You pay for his subscription, and every week he comes out with analysis, Fed policy, all sorts of charts and graphs. Usually it's anywhere from 25 to 35 pages long. It's a lot of fun on all the junior gold miners out there that are in the portfolio. Jordan, thanks again for coming on the show. This was a lot of fun.
Thanks so much for having me, Steve. Really enjoyed it.
All right, take care.